Well, we believe that the strong assets will keep getting stronger and the weak assets will continue to get weaker in 2019. It's more important than ever to be acquiring the right assets in the right spots. And to know where the right spot for investment is, you must just follow the job growth. We believe that the strongest job growth is here in Toronto in the GTA, where we've seen the expansion of the tech industry, and in other major markets across Canada, most notably in Vancouver and Montreal. So we expect that we'll see value appreciation in those three markets, Montreal, Toronto, and Vancouver in 2019. With respect to where we are in the cycle, we keep hearing that we're late in the cycle and that there should be some correction coming. However, we feel that with interest rates at reasonably stable levels and not anticipating them to go up very quickly or very much, with strong operating fundamentals, we expect a stable environment for the rest of this year. Perhaps there will be an evolving economic environment thereafter, and we'll just have to see what challenges that poses and, more importantly, what opportunities arise from that.
Well, we've seen cap rates, of course, come down, compress over the last many years. We saw that continue even in 2018, I'd say well past the point when many industry observers would have said that cap rates can't get any lower. Thinking or speaking specifically about multi-res, where we're active, we've seen cap rates in major centers like Toronto be in the low to mid threes for some assets in some locations, believe it or not. So I think that the absolute floor is hard to predict. I would be very surprised if it would continue to move much further. The spread between cap rates and the underlying cost of financing is a little narrower than where it has historically been. And I think that sort of brings us to the question of, where are costs of financing going? And certainly we saw a bit of a spike associated with some equity markets volatility, bond market volatility late in 2018. That sort of had come in January and February of 2019. I don't think that we see interest rates spreads coming in a lot from where they are now. There may be a sense of a gradual upward trend in cost of borrowing. And so as a consequence, I would find it hard to believe that we're going to see cap rates compress much in the future. I would expect that they'll probably flatten a little bit, and we may see potentially at some point in the future them expand a little bit again. But that's sort of our view, I guess, of what we're seeing in the market right now.
So when we look at real estate valuations in Canada for 2019, I think we have opportunity for real estate valuations to move up. I think that's going to be driven by NOI growth. I think that strong fundamentals, especially when we look at the multifamily and industrial sectors, are going to drive revenue growth. I think there's opportunity for operating efficiencies as well that can generate some strong NOI growth. When we look at cap rates, I think we're going to see general stability in terms of cap rates. Even should we see a bit of volatility in interest rates, I think we're going to see cap rates stay pretty flat.
I think it's fair to say that we've had quite a run of cap rate compression and value increments in most classes of real estate in Canada over the last 10 to 12 years. A lot of that movement upwards in valuations and compression in cap rates has been a function of declining interest rates and the abundance of equity and debt capital that is being used to facilitate both acquisitions and development of real estate in most Canadian markets. So notwithstanding that we have seen over the last 18 months some upward movement in interest rates, you would intuitively expect that cap rates would be moving higher and valuations perhaps should be moving lower. Ironically, just the reverse has happened. So we've seen further cap rate compression and further value increments, again in every class of real estate in Canada over the last several years. And so as we sort of enter the latter part of the first quarter of 2019, we expect interest rates not to be moving higher, to at least remain status quo, if not reduce nominally over the next 9 or 10 months. And so with that, one would expect, again, given constant demand and availability in the capital markets, that cap rates and values for most classes of Canadian real estate should remain constant. And in fact, in some cases, we would expect to see some compression, further compression of cap rates in some particular markets. So certainly the larger markets in Canada will continue to see cap rate compression just because there is an abundance of capital chasing very few and limited opportunities, and that will create pressure on prices and values. And similarly, again, because of perhaps the stability in interest rates and perhaps even some modicum of decline in interest rates over the next 9 to 10 months, we may see some demand in secondary and tertiary markets for income-producing properties. So first part of the question, personal opinion is that we will see as a minimum stability and perhaps further cap rate compression in value increments. With respect to the second part of the question as to where we are in the cycle, it's a great question. I suspect we're in the latter part of the cycle. The question that everyone is trying to predict and answer is how much time is left in this cycle before we hit a reversal of fortune, so to speak. And the simple answer is that remainder in this buoyant and upward moving cycle is largely a function of interest rates and demand for real estate by equity and debt capital that's chasing limited opportunities. So unless we see a tremendous downturn or black swan type event and or interest rate movement upwards, there's a strong likelihood that at least over the next 24 months, notwithstanding that we are in a late part of the cycle, that we're going to continue to see stability and perhaps further increases, albeit modest, in property values in Canada. One of the key elements and key question marks that I guess most are looking for is what happens with respect to the U.S. election in 2020, and what will that upcoming election do with the markets, the capital markets, and what impact might it have on interest rates and the direction of interest rates, assuming, as we've seen over the last several decades, that we do see some tightening of interest rates, at least in the U.S., and presumably Canada is going to follow suit. That will hold well for a continuance of the current economic cycle and its impact on Canadian real estate.